Yes.
And what's up, 1%ers? I'm Ryan Daniel Moran, and this is the second handsomest man on this this video podcast now.
Thank you, man.
How does it feel to be the second handsomest man in the room?
Man, I didn't know there was going to be an award given out today. That's pretty
Well,
good.
the handsomest is cardboard cutout Ryan.
Understood.
He's over
Great
there
listener.
somewhere.
Great listener.
He is a great listener. Hey, so Sam is one of my economic advisors, you could say. He's who I go to when it comes to buying cash flow, it comes to actually setting up the proper structure for my financial house. Is that
Absolutely.
If I say anything that would get me in trouble with the FTC, can you warn me before we do
I'll
that?
kind of kick you under the table a little bit.
Yeah, that'd be
I'm
perfect.
going to go a little bit off the radar.
All right, cool. We're not recording this at all.
I like it. That's perfect.
But today we're going to talk about cash flow. We're going to because Sam does some really cool things when it comes to buying cash flow and structuring it in a way that is advantageous. But first, before we do that, what the hell is going on with the market right now?
No, it's a super interesting time because we have so many unique factors that are going on in the market right now. And one of them that I think is overlooked is just what the Tax Act is doing to the markets. Like, it's pushing a lot of dollars back into the economy because people are wanting to make investments to reduce their tax burdens. So you kind of have some.
Well, how do you measure that? Because when I say market, I mean stock market.
Yeah.
And so we just up and down, up and down, up and down. So a lot of people have said that the tax bill was negative for the stock market, and you're saying something different.
I think that honestly the tax bill overall was positive for the market because what it's done is it's put a lot of money where businesses are reinvesting back into their profits because they're wanting to reinvest those dollars to create the tax cuts or to utilize the tax cuts.
Right.
So they're putting more dollars back into the economy because as a whole, like the way that the macro economy works is one person's spending is another person's income. And so when one business spends money on marketing or acquisition and those sort of things, or to acquire more customers to be profitable, but their spend that they spend is making another business profitable as well. So the more people spend, the more the economy overall grows.
Of course. So again, what the hell is going on with the stock market right now?
So here's what's unique right now is one of the ways that we're able to spend money is you can spend money using a few different fashions, but one is cash, one is credit. So credit is the money you can borrow. So as we have right now, we have the Fed is raising interest rates. So the thought is that as interest rates rise, people should be or will likely borrow less over time. If we if we raise rates tomorrow to 20% to borrow, no one would be borrowing money at as aggressive a rate as we're borrowing today because it's more cost prohibitive. Make sense? Mm-hmm. And so if those rates continue to rise, like here's what we're trying to do is we had rates slammed all the way to leverage slammed all the way down to zero, very close to zero.
All right, I don't want to go there. I want to go, where should I be buying right now? Or should I have my opinion and I'll share it, but you, who is geeks out on this stuff, should we be buying or should we not be buying right now?
Buying into the stock market?
Yes.
I think right now I'd still be very, very cautious of the stock market. I think I'll be very cautious of the economy as a whole. I think that we have
because of interest rates and because of
the exactly what I was getting into is if the interest rates continue to rise, here's one of two things happens. Either we deleverage, where people slowly slow the roll on borrowing a little bit, but we still maintain slight economic growth, or if that rate raises and people really do start pulling back, people quit borrowing, people quit spending, that's what drives economies into recession. Mm-hmm. And that's the fear that is there, and that's what would create a more significant pullback than the little bit we've seen here now. Just the thought of those rates rising and people slowing down was enough to give the market quite a bit of a waiver.
So here's where I'm confused because as we're recording this, market's up today, mm-hmm. Market was up yesterday, market was up the day before that, but right before then we just saw just people were dying on Wall Street. I mean, it was a horrible bloodbath, and I'm still fairly confident that the market's going to come back to the Dow will come back to about 20,000. Just looking at the overall trend, mm-hmm. But when we have 1,000-point moves to the positive, it makes me go, well, was I wrong? So could you help me understand what's the reason for all the crazy volatility, and what do you think is going to how is this going to end up settling?
Yeah, so I think the reason for the crazy volatility is what you have with the American public in general. And just think for a second, the market is not always right. So the market is not the only indicator we should focus on when it comes to the health of the economy. And so I'm going to give you a personal anecdote here. I live in Oklahoma. And so we invest a lot in oil in Oklahoma, and I have family in oil, so I track oil pretty closely. And so in 2016, we had the big pullback in oil. That was a great pullback, created a lot of value, a lot of opportunity. And one of the stocks that I've tracked for a while is OKE. It's a dividend pipeline stock.
OKE.
Yeah, this is not a stock pick time, but yeah.
Okay.
Kind of keeping it down with Disney, but so for example, that is a midstream pipeline. And so what you're doing is your profitability, the dividends you make on that, like how profitable that stock is going to be based on how much oil flows to the pipeline.
Sure.
And so when oil pulls back down to $29 a barrel or whatever it was at that point in time, that really doesn't have a huge effect on the amount of oil that flows to the pipeline, because somehow, unless we are in a recession as a whole in the U.S., we're still consuming that oil.
Right.
So someone's going to produce it. They may not like to produce it as much, but it's going to produce. It's going to flow through the pipeline, and you're going to receive your dividend.
The dollars don't affect how much
the
oil
cost of oil
is.
has no effect or no significant effect on the value of what's being produced there. So, for example, like that stock took a massive hit during that time frame because everyone said, okay, oil's going down, therefore we need to jettison everything related to oil.
But the production is still the same, and so Uncle Sam comes in, Uncle Sam, comes in and says, this is a good time to buy this because the production is still
correct.
there.
And so the metric they should have been looking at is, are we in a recession or not in a recession? And that's why I think like the macroeconomics are so important to know, is when you're making these decisions of what companies do you buy, where do you put dollars, is we want to look and say, okay, what factors should we be focusing on? Should we be focusing on the price of the commodity, or are there other factors we should be focusing on?
Right. So instead of factoring in the price of stocks, what are you factoring in? Interest rates, you mentioned. What else?
Interest rates are a big piece in the puzzle because that's one piece of it. There's some other data points of just overall economic health of growth, like jobs reports are one thing that are factored in there as well. And that's going to be interesting. That's something with this government shutdown, which we're all
the most recent jobs report was fantastic.
It was really fantastic. This next one will be interesting to see because technically, I read somewhere, now this was CNN, so you have to take it with a grain of salt. But I believe that when they do the next jobs report, it will, those that are on furlough may be factored out of that. And so like it could create some skewed numbers there, which to the average person may look at that and not think twice because it really shouldn't make a huge effect on the economy long term. But for the short term, it could show a skewed job.
Well, let's just hope it's up for the long term and the government just stays shut down forever. Let's just hope that is the case.
Maybe a little smoother transition than that.
I'm on team shutdown for as long as possible.
So someone gets the red button and that's enough?
Yeah, just shut it all down. If I'm elected president, I would come in and be like, all right, so bring me the list of things that stayed open during the last shutdown. Okay, cut everything else. That seems like an appropriate size of government for me. Anywho, okay, so the way that I'm kind of internalizing all this is, all right, if we stop being so obsessed with the numbers of what the market is doing, then we just look at overall production, and it seems to me like production's pretty darn good.
Absolutely.
So why stay away? So why stay away from stocks?
So the reason behind this is, here's where we sit, is so the Fed has had the same kind of deduction that you've had when it comes to what they can do. So when they're raising interest rates, that means the Fed is indicating that they believe that the economic health economic health of the U.S. right now is strong enough to raise interest rates, which may reduce the amount of people borrow, but they do believe that the economic health is there. And so with that, part of the reason that I think that stocks are a little bit of an issue right now is they're overvalued. You look at what you have to pay to get. It's just like buying real estate. The reason stocks I think are difficult is people have trouble, disseminating back down to the individual what you're actually buying, because you buy a stock. What are you actually getting? Like, why do you get a dividend? How does that actually work? It's much simpler. You break it down to something very, very simple. Break it down to a home. You say, if I want to go buy a $100,000 home and I can get $1,000 a month in rent, my home will appreciate and I'll get my cash flow. Kind of the same thing of buying a stock with a dividend. Your stock will appreciate and you'll get your cash flow.
And if the value of the house goes way down, you're still getting $1,000 a month in rent.
Absolutely.
So where I'm concluding kind of affirms what I have decided up to this point, which is I think that in 2019 you're going to have a significant correction of prices but that does not mean that there's a recession.
To realign prices with value, absolutely.
Right.
I think that's exactly what needs to happen. What will happen is we had a lot of economic growth that happened due to hope and excitement and all the things that get people going. That's great.
I mean, when Apple was valued at $1 trillion, it went up past $1 trillion because it was like, well, new threshold.
Right.
In 2019, no company is actually worth $1 trillion worth of production.
Mm-hmm.
So it has now cratered, and as at the time that we're having this discussion, it's at about half, a little bit more than half of what it was.
Absolutely.
Now we're in almost reasonable valuations of a company with $100 billion sitting in cash reserves.
Think about the challenge that's there of how do you actually get to those valuations and how do you get to that point? Like, to evaluate that, you need to have a certain amount of data to look back at. And what data do we have to look back at on Apple? I mean, think about how quickly technology has advanced. Like, technology is an exponential curve right now with how quickly everything's growing. You think about 10 years ago where technology was and where it's at now, and think where it'll be in the next 10 years. So evaluating what is going to happen with the company over the future is just very difficult because it's not like we have 100 years of retail history to look at. Like, we have a lot of things that are rapidly changed in the economy, and so that's why these valuations. I think we have some pretty
crazy,
very
unreasonable.
Like you have perception can change that valuation very significantly based on the changes.
And that would cause a lot of these crazy swings
that's
that
why
we're
you have
seeing.
Such a difference in the valuation.
So me as somebody who is, I have a minor in economics. I geek out on this stuff. As somebody who is probably more sophisticated than most, I still only feel like I get a sniff test of what is going on overall. And so the average person knows so little. And so what I've concluded and what I have encouraged my other amateur, not financially savvy peers to consider is using cash flow as the indicator of if you're going to enter into an investment or not. Just like you made the decision on the oil investment, if cash flow is your production, you're buying the production rather than the value of it. So when, for example, AT&T fell to $29 and it's paying a 7% dividend, I am like, give me all that AT&T stock, please. I will take a 7% dividend. Do you agree with that type of an approach?
Well, first off, I hear if you buy enough AT&T stock, your coverage will actually work. But no, very much, because what you want to do is my rules for investing are pretty simple. Like, I really do believe, like, number one is you should invest in things you understand. And so if you don't understand it, at least take the time. Like, we live in the information age. Go to YouTube, go to Khan Academy, learn how stocks work. But once you understand something, then you invest for cash flow. Like, cash flow has to be a priority. The reason people go bust, the reason people lose money is they don't have sufficient cash flow to lash through a variety of different situations that might happen. So, for example, if you go buy all your money in AT&T stock, or not AT&T stock, but a stock like AT&T that doesn't have cash flow, and you're just looking at just the equity growth down the road, so you go buy ETFs or index funds or things like that, without a cash flow component, and then you need to have access to cash flow because cash flow is how the world goes round, you end up having to fire sell assets because you sell at a loss, you go bust. If you have cash flow, you can weather those storms. So even if you buy it at 29 and it goes to 24, you don't have to exit at 24.
I'll probably buy more.
Because your horizon is long enough. Like, your horizon for how long you can hold the asset. And cash flow helps extend that horizon, perhaps, if the cash flow is consistent, to infinity.
Yeah.
And that lowers your risk significantly. From like a safety aspect, not having to liquidate something is so key.
So here in my analysis is why this time is so scary to a lot of people. And for me, when the economy is going up and down and up and down, I'm getting excited while everybody else is scared. It's because most people, when they're buying index funds or they're using an advisor, they're just banking on the dollar value of the investment going up, and they're afraid that it's going to go down.
Right.
Sam and I are both under the opinion that it's probably going to go down over the next couple of quarters. But on a smaller basis, when you're looking at something like the cash that is coming in from the investment, now you can be more strategic about, there was this big drop. I'm gonna buy Apple, which now has a 2% dividend, or AT&T, which has a 7% dividend, or IBM, which has a 6% dividend. And to me, that's smart and long-term thinking rather than getting emotionally involved in all of this roller coaster.
Without a doubt. And the fear is there's always that fear of loss. So when you think about investing, one of the reasons people sit on money or sit on opportunity and miss opportunity is because the fear is that if I put money in AT&T today, I can get it in a week. I can get it cheaper. Or I put money in Apple today. I can get it in a week and get it cheaper.
Right.
And so it's that fear of what if I buy it now and then miss out on something, or I put money in AT&T and now I can't put money somewhere else. And so of course that's part of managing the overall your portfolio. You just want to keep certain amounts of liquidity. And so as a general rule of thumb, I would be deploying capital right now to a certain degree, but I would try to maintain a good, healthy percentage of liquidity on my balance sheet. And there's a lot of ways to maintain liquidity, but liquidity
meaning
is
cash or access to cash.
Equivalents. So things that you for example, if you have gone, you've bought your AT&T stocks or whatever, and you have other liquidities that are out there, you could use margin calls to be able to, or margin accounts to be able to get access to capital and not tie up and have to sell and liquidate at a point in time, at an inopportune point in time. You could use, there's home equity that you can use as lines of credit, sort of thing. So you can use credit to manage that liquidity, or you can just use straight up cash and cash holding tanks. So capital warehousing, savings accounts, other liquid vehicles that are not exposed to volatility. So that way, when the volatility happens, the assets you bought may lose value, but they still cash flow. But now you can go in here and you can go buy at a value and you have liquidity there.
So the way that I'm doing that is I did just borrow against one of my homes right before interest rates continue to go up, because I can see that happening. And check this out. I ran the numbers and I was like, can somebody tell me why I shouldn't do this? Because I borrowed against my house and I'm taking advantage of the volatility by selling naked puts, which is a way that I generate cash flow. And also if there's another, I can still buy the stock at a lower price if it continues to go down. Story for another day. It's my favorite way to buy stocks. But so I borrow against the house. I'm now selling naked puts, which is generating enough income to pay the mortgage. And then when I actually buy the asset, I now have the dividends as free cash flow, we might say. So that's kind of my way and I have the capital warehouse with you, of course, as my umbrella to make sure that if I'm not doing anything, I'm still participating in the upside of the market without any downside.
Absolutely.
So besides stocks, what other interesting cash flow plays are you making right now? You always have a cash flow trick up your sleeve and you're like, I can dig holes and fill them and it produces cash flow. You always have an interesting way that you are generating cash flow passively. So what are you hustling right now, Prentice?
I can entertain you for a bit here. No, it's one thing I've been really fortunate is just with my network of the clientele that I work with, a lot of high net worth individuals, I get to see deals all the time. And so I offer that as kind of one of my value adds to my clients is I say, anytime you have a good deal that you're interested in investing in, bring it to me and I'll look over and give you my opinion on it. That's all it's worth. It's an opinion. I'm not going to advise on what you should or shouldn't invest in. I mean, I do give that out on occasion if I say this is dog meat, don't go there. But for the most part, I get to see a lot of unique things. So one of the ones that I've invested in here recently, I'll go boring then interesting. So boring.
Just go straight for the interesting.
Straight for interesting. Okay, all right. So straight for interesting. So we bought a saltwater disposal well. And so what saltwater disposal is when you go produce oil, you bring up, in addition to the oil, you also bring up a lot of wastewater. And so the wastewater has to go somewhere. And so when they produce the oil goes in one tank, the wastewater goes in another tank. Someone drives up with a truck or they use a pipeline and they take this wastewater, this nasty, gunky crap, which has still got a little bit of oil mixed with it as well. They take it over to a facility. It goes into some separators. It sends the sand and junk to one spot. It sends the water to another spot, and the oil that's mixed with the water to another spot as well. And then that water then gets pumped. Now that's been treated, it gets pumped back downhole and gets dispersed back into the formations. So basically, you're buying a facility that is a peripheral to the oil industry. So basically, they pay X number of cents, 50 to 60 cents or whatever per barrel of water that gets disposed. When you produce oil, you normally produce 3 to 5 barrels of water with each barrel of oil at the same time. So there's a need for it. It's a real need. It's actually it's basically a commodity to the oil production industry. So we bought one of those disposal wells, and it was a really unique deal. But long story short, went in there, bought a distressed well that had been hit by lightning. The facility
literally hit by lightning.
Literally hit by lightning. And so the whole facility had to be wiped out. it had been out of operation for 2 or 3 years, but the wellbore was in good shape. And so we were able to still use the wellbore, which is where the water goes, it's a hole in the ground. And so we literally bought a hole in the ground to dump water into. And now we built a state-of-the-art facility that's out there. So you build the facility, and we were able to take water in at that point in time.
So when you're buying these, I mean, I know your overall strategy is you park cash in a warehouse that goes up in value, that never goes down in value. Uh-huh. And then you buy cash producing assets with that.
Correct.
And because of your network, you have these cool cash flow plays.
Correct.
So here's what I want to understand here. When this opportunity comes to your desk, are you buying a business? Are you buying a piece of land? What are you actually buying that is producing profit? Like it's fun to say, I bought a hole in the wall that we put wastewater down. Great. Okay. But what are you actually buying that's producing the cash flow?
It's actually it's technically a business because there's a lot of moving parts to this. That's a great question. Like, you lease the wellbore typically. And so that's a lease that's held in perpetuity based on sending stuff down it. And then you build the assets. You're actually buying the facility. So there's pumps, there's things to operate. So you have, a pretty significant amount of equipment that is used to operate this. You purchase the equipment, and then after that, you're building the business off of that.
And is someone coming to you with like, I want to build or buy this business? And then
eventually, yeah. So right now, and actually, this is really unique because you can look it up and look up saltwater disposal, wastewater disposal, and look up Mark Cuban, because they had a pretty good buy of wastewater disposal wells here recently, some of their hedge funds. And so it's an interesting market space because it's an aging demographic. So a lot of these well bores where they're disposing were owned by older farmers, older operators. There's a lot of deferred maintenance. So deferred maintenance is a glorified way of saying you don't take care of your crap.
Mm-hmm.
And so but they said it's cash flowing, so they may operate at 30 or 40% of full capacity. And so people have to drill a new wellbore, which is like $1 million expense, or they just drive further away to get to it. So they may not go to the most efficient routes. There's a lot of inefficiency in that market space because as people have aged up, they're not taking care of their leases the same way, and therefore they're not able to operate at capacity.
Yep.
And so that's where some of this value is coming into play. Is you're able to go in and buy, renovate, and take in some of that cash flow by how efficiently you operate, because that's what they're looking for when they dispose of water. Is they want an efficient facility they know they can predict and count on to go disposing.
So, if I'm understanding, somebody's basically in the business of buying up distressed holes in the ground that produce money. That's their business.
Absolutely.
And now you get to participate in that type of a business.
Yes. Yep.
So your financial strategy and what you talk about publicly is you park your money in a warehouse, and then when the right opportunity shows itself, you're then going, holes in the wall that produce cash flow, or holes in the floor or in the ground, whatever the term is.
Right. Fast forward about a year of research on that, because at first, when that deal first came to me, to be honest, I heard it, and I thought, that's probably not going to work. And so but it was interesting enough. And then I saw, actually, it was maybe a month or two after that, I saw the article come out with Mark Cuban purchase, and I thought, well, maybe I should pay a little more attention to this. So I dug into it for about a year. And after going through and looking at all the different risks and the pros and cons to it, I found it to be an attractive business model. And so at that point, I probably did a little more digging on that than I needed to.
More digging, holes in the ground. So here's a question: how does the average person who is waiting for the right opportunity, is looking at the market, going, I'm probably going to sit on cash for a bit, unless they're buying like we buy, which is looking for cash flow. Mm-hmm. They're waiting for the right business or deal or something to go into. How do they put themselves in position to where these types of opportunities are flowing towards them?
Great question. That's one of the things that I feel like is a very underserved sector of the market today. So the financial services industry. I hate to
You mean like the opportunity market? The
opportunity market. So people who are looking for places to invest capital typically get very limited exposure to what all is actually out there. And so that's one thing that I think is really important and that I'm looking to improve in 2019 is I want to offer some resources to investors where they'll be able to go look up and just see, even if it's not in deals you invest in, just see what else is out there when it comes to alternative assets to just what is mainstream. Because there's a lot of things you can do with mainstream, with real estate and stocks that'll get you to a decent spot. There's a lot of other alternative assets that are very unique, that have impact on your balance sheet that are attractive. You know, like for example, you buy cash flowing websites. Who would think of that? That's not something you see. That's not something you hear from Morgan Stanley or something you hear from Edward Jones. But it's an asset that
Why do you think that's the case?
It's all about what is scalable and what's profitable, in my opinion. And so
meaning that Morgan Stanley can't go out and buy
institutional wealth,
a whack ton of websites because they need to be managed, and there's like tiny small businesses and their individual deals. But average guy on the street could go buy a website and write the thing off and enjoy the cash flow from that.
And potentially have active involvement in that as well, and in which case you may be able to have some tax benefits from that. And same thing with like the oil investing or buying real estate. Think about buying real estate. There's a reason why REITs return less than individual real estate typically, or I guess that's debatable. You either usually have one spectrum. If you're good at real estate, normally individual purchases are better than a REIT because you're able to provide your own unique value into the decisions that are made. Your active involvement helps boost your returns. Because that's kind of one of my other rules when it comes to investing.
I see what you're saying.
Yeah.
There's either time or there's passive returns.
If you have the ability to be active in the decision-making process of your investments or to be active in the operation of the investment. So for example, like if you're deciding where you put your money and you have not maxed out what you can do invest in your business, I think you're potentially making a big mistake. And actually I had that conversation with the person in the back room here maybe 6 months ago. Because they were routinely doing all the things that you would do as a good upper middle class person of saying, okay, I'm going to save money into my 401k, I'm going to save money into my IRA, I'm going to put money into the stock market, I'm going to put 20% of my income into general, regular, big, old school long-term investments and target date funds, those kind of things. Which I'm not here to argue whether or not those are good or bad. I'm just saying in their case, right now they were going over here and borrowing money from other institutions at an annual rate of probably 17-18% is what that boiled down to. So, and it's to finance things in their business that they feel like has a very high predictability. So the question is it's very simple, is would you rather save the 17% you're borrowing and paying interest and just use that money for yourself? Or would you rather go pay the 17% to be able to invest? So if someone said, I'll give you money at 17%, and you can go.
I have no idea what you're saying right now. There's way too many numbers.
Let's go back here real quick here. So for example, they have a business. They can put money in their business and they can create cash flow. Instead of using their own cash, they're putting their cash into the stock market and these target date funds.
Oh, yeah, that's
and borrowing to fund the business. So it's almost like they could use their cash flow to fund the business, and instead they say, if someone gave you money at 18%, would you go put it in the stock market? And the answer is probably not. You're probably going to do better investing your money and saving the interest you are paying as opposed to putting it in the market. That's just my personal opinion.
Yeah, I might disagree with you, and the reason for that is if you can predict that 17% debt is going to roll into buying more inventory that you can now sell through.
Oh, absolutely. No, I get that completely. But my point is why would you not do both if you could? Why would you not why would you utilize your capital to go over here and tie it up in the market when you are limiting how much? Because they were running into credit issues with how much they could borrow. So they were hitting limitations of how much they could invest in their business because they had their liquidity tied up over here in the market.
So let's talk about, we were talking about some of the interesting things that you buy up. I love that you can buy up holes in the ground and they cash flow. I'd be curious if there's any other stuff that you're considering in lieu of the tax changes.
Yes.
Because you are like among the three people I go to that is very in tune with some of the strategic advantages in the new tax code. Yeah. So and you mentioned earlier that a lot of investors are changing their investment habits based on what's going on with the tax code. How has it impacted yours?
This is really unique. So I feel like there are some quantum leaps made in how effective real estate is when it comes to mitigating your tax burdens over with the Tax Cuts and Jobs Act. So let's go through just like one of the biggest things that happened here that I think took place that is underutilized by investors right now, but any properties that were acquired post like September 21st or 22nd of 2017, you are eligible for the new bonus depreciation rules. So depreciation is where you buy an asset for X number of dollars and then you get to write off and you depreciate its value over time as you hold it. Well, what bonus depreciation is it says that anything under a lifespan of 20 years, you're able to write that off all in year one. So you can accelerate that depreciation, write it off all in year one. So when you buy real estate, typically you depreciate real estate if you do flatline depreciation. You normally do it over 27 and a half years or close to 40 years for commercial.
And it's like 2.9% or 3 point something per year.
So you're depreciating usually at a very slow decline. With the new bonus depreciation rules, what you can do is you can go in and do what's called a cost segregation study. So cost segregation is where you divide out the different parts of the property. So there's flooring, there's piping, there's concrete, there's roof, there's windows, there's et cetera, electrical. And so you go in and you do this cost segregation study. So each cost has its own box, and now you're able to depreciate those at different rates. So you may be able to depreciate the flooring at 10 years, you may be able to depreciate the copper wiring at 15, you may be able to depreciate the roof at 30. So you go through and you do this whole cost segregation study. Well, now maybe 30-40% of this property on single family, and it can go up more with other types of real estate. You're able to write that off in year one, or able to depreciate that in year one.
And is that improvements made?
No,
or is that
that's
just pieces of the house?
That's pieces of the house.
So if you bought a house after, let's just say October 1, 2017, after the new tax law came into effect, you could segment certain parts of the house and take all of the depreciation
for those
year
portions
one.
of the house. Absolutely. So what you do is you take the property, and so say it's $1 million property, you now take $300,000, $400,000 of that property, and you're able to depreciate that all in year one. Now that is depreciation you have to recapture when you sell, but if you're buying something for long-term cash flow, you can take that, you can build it up, and it can carry forward if you don't use all of it this year.
Yeah.
So what I think is going to happen is over the next 5 years, you're going to see a lot of money going into real estate because they want to build up these tax offsets. And so, I mean, the numbers on it are really pretty impressive. So you buy $1 million of real estate. How much money do you have to put down to buy $1 million of real estate typically?
$150,000 to $250,000.
Absolutely. So $200,000, 20%. We put $200,000 down, and now we've gone and acquired this investment property that's $1 million in value. So we put $200,000 out of pocket to create a $400,000, $300,000 to $400,000 tax write-off.
Yeah.
And if you're at a 40% net tax bracket with some state tax and everything else mixed in there, now all of a sudden we're actually literally saving real taxes. $150,000, $160,000 of real taxes we're not paying.
And if it cash flows,
our risk is very limited. So here's the thing, like mechanics. Yeah.
I mean, that justifies the down payment. You're actually saving money by buying the house. Absolutely. And so what you are saying is you think there's going to be some money flowing into real estate.
It makes
for that
reason. A no-brainer. So just think, like, you just take this to institutional levels. You have a lot, and the thing is first off, who this is for is if you're not paying a significant amount of taxes right now, it means you're probably, if you're watching Ryan's show, it means you're probably building a business. That's excellent. That's one of the best places you can put your time and your capital right now. So you're not paying taxes because you're reinvesting everything back in your business. That's exceptional. That's wonderful. Keep doing that. Don't stop that. But once you get to the point where you have those dollars you're trying to reinvest in other things outside of your business, and you are paying when you're paying taxes, then that's when these become really attractive. These strategies become attractive. So you want to know, like, do you have a high tax burden? And that's something that would make this attractive to work with. And then also, are you able to use real estate losses to offset, because you have like passive loss limitations? Are you able to use those to offset your ordinary income or just other real estate gains? And so that's something you want to look into based on what you qualify for from a tax status. So if you're married and you have the ability to have one of you qualified as a real estate professional, you already invest in real estate, there's some really neat things we can do to actually use this to offset your ordinary income. So there's some limitations on who all can participate in it, but there are. I mean, it's when you fit the criteria, which is very basic criteria to fit. When you fit that criteria, it does make it a lot of no-brainer, which is why I think there'll be a lot of people who will be dumping money into real estate.
What should the average business owner be doing in 2019 in lieu of, or in note of the fact that market's very volatile? We both think it's going to go down. We don't know. We might be wrong, but I think Dow is going to 20,000 in the next quarter.
I like another bold prediction there, Ryan. That's good. I'm complimenting you before.
I won't shy away from them.
See.
And Amazon's going to make another acquisition. That's my other bold prediction for the year. We've got a new tax law. We've got uncertainty in DC. We've got all kinds of uncertainty. What should the average business owner be doing right now
Average
in
business
order to
owner.
maximize this year and this time
I love
and acquire passive income?
I love general questions like the average business owner, because we all know that average business owners fit in this perfect little box. So no, I think, and when you think of average business owner, it's really.
What should they do, Sam?
I'm gonna get.
What should they do, Sam? No, what do they do?
I'm not gonna allow you to get there. No, I'm just kidding. But no, so we will. I will get there. But what I'd say is the average business owner. When you think of business owners, there's different stages they go through. So if we're gonna define average as a business owner who has passed the point of putting every dollar they possibly can, they own, and every dollar they can borrow, and every dollar they can think about borrowing into their business, they're past that growth stage. They're into the point where they actually hold and run reserves. That's the average business owner. So just kind of use that as your metric. Is if you are not at the point where you are consistently holding reserves in your business, this is probably the advice I would give would be different for you. You should be still in growth mode. You keep working on that. That's your job. Come talk after this. But for where we're at right now, if you're the average business owner, you have those reserves. What I use personally and what I think makes a ton of sense is the capital warehouse strategy. So we use a capital warehouse strategy when we're in a coin flip environment where things might go up, things might go down.
Now,
which is right now. We can play both sides of the economy. And what's so beautiful about this is like this last year, for example.
That's where you park cash. And it's tied to index funds, so it'll go up, but it doesn't go down.
Correct. So it's tied to stock indexes. And when the market goes up, we gather the upside. When the market goes down, you just get a 0% credit. And so there's some mechanisms for how they get that done. But basically, what we're doing is we now have a place to store capital. So when you don't have the headspace to go figure out exactly what you want to invest in, or you're not positive you can tie that capital up, you really need a high level of liquidity. Because you say, I don't think I'll need this capital, but what if? And then if that's your thought, or
what if the right opportunity comes and I can buy up wells that produce cash flow.
I don't care what your what if is followed by. If you think I would like to invest money, but what if that is the way your mind works right now, then you need to talk and look at a capital warehouse. And that's common, because your what if could be, what if my business needs it? What if the better investment opportunity comes along? What if I list any list of the what ifs that are out there? This is a great stepping stone, because what it lets you do is it lets you invest, lets you have the upside, but maintain all the liquidity. So it's kind of it's the friends with benefits of investing, because we're able to go have all the upside, limit the downside, but stay liquid the entire time. So that's where I would start with on that side of it.
So we should just say full disclosure, like honesty, transparency. That's part of your business of what you do for people. And I'm a client of Sam's using that strategy with Sam specifically. I've told my nightmare story of hearing about it on the interwebs, thinking it was cool, and then having a salesman kind of take me to the ringer and take all kinds of fees and commissions. And I thought I was doing something financially healthy, and it wasn't.
The story of what is your goal? Well, here's my goal. The best way to get that is to buy whole life insurance. I do not ascribe to that theory in the least.
That was a joke, ladies and gentlemen.
In case we didn't catch, that is very much a joke. And the thing is insurance is very useful when it's structured properly. What it does, it helps you manage cash flow. It helps you take advantage of upside, limit downside. There are a lot of really positive things to it when it's structured properly. But it's equally as good as it can be when it's structured properly. It can be equally abrasive to a balance sheet when it's structured improperly. So you really just you cannot be too diligent in that.
So you've got this pool of cash now, which grows but doesn't shrink. And what should people be looking for? And we're looking for cash flow plays, obviously.
Yep.
I buy dividend paying stock at opportune times. You have deal flow that comes in all the time. But what should people be looking for? Like, great, I'm going to park it here and wait. What should they be looking at while we're waiting to see how the market is going to go?
I was thinking about I was trying to decide how many fingers to hold up for criteria I wanted to give, because I want to be like 10, but I'm going to limit it to 4. So number one, something you understand. So something that you can understand and you feel like you understand the business model, what you're investing in. Number 2 is it needs to prioritize cash flow. So those things, and the reason I'm not giving you a specific investment is because if you understand the criteria, the investment will be much easier to find. And with business owner situations, there's such a variance there. I want to be a little bit more vague with that. So number 1 is something you understand. Number 2 is something that prioritizes cash flow. Number 3 is something that you see value in, that you believe has long-term value or value for the horizon. You may like to or need to hold the asset. So for example, investing in Sears right now may not be the best investment for you because you might not see the horizon long enough to outlast your investment. I mean, I drove by one on the way here with some boards on the doors, so that's probably not ideal.
It's not a good sign.
Not a good sign. Want to invest in things that we think are likely to get there. And then lastly would be is understanding your individual situation and looking for, there's macro value, that's value to the overall economy, and then micro value to you individually. So for example, if you're already way ahead on taxes and you need more liquidity, you may need a certain kind of investment that focuses more in your specific needs at that time frame, as opposed to someone who's got a high tax burden. So someone who has a high tax burden, when they go and a high tax burden and they understand that they can offset regular income with real estate losses because they qualify for that, well, that becomes a no-brainer for what they invest in, because now they have a 40% discount on their purchase price. So they have a micro value that is unique to their situation. Does that make sense?
Not at all.
Okay, so let's go back here real quick.
No, I don't want you to explain it more. I want you to tell me what people should be investing in.
Okay.
So here's like real estate meets all those criteria.
It does.
Businesses could meet those criteria.
Real estate,
Dividend paying stock could.
Absolutely.
But it's all dependent on that first piece, is like, what do you understand?
Mm-hmm.
Like, you took a year to understand the investment that came to your desk.
What I would look for doing when it comes to that is, the reason you diversify is you don't diversify to make more money, you diversify to mitigate risk. So that's kind of piece number one, is when everyone thinks I want to go diversify, you diversify to mitigate risk. So if your goal is you want to grow your capital, you want to grow it as efficiently as possible, you're probably going to feel more comfortable if you're able to diversify to some degree. Make sense?
Mm-hmm.
And so being able to diversify, part of that is it's just like building a business. You don't go do everything yourself. You go find quality people.
I completely agree.
And so when it comes to investing in those things, I would say try to diversify your balance sheet into various cash flow plays that hit the guidelines I was giving you, but use quality people to get there. So instead of you having to go spend a year learning each thing, you go find people who you believe have the right, they have the right competency, the right character, all those things that you would want out of someone who's going to be taking over control of your money, and use them to manage those assets. So if you want to go invest in real estate, go find someone who, the type of real estate you like, the geographic location, figure out macro what you want to do, and then find someone who's an expert in that particular field.
Yeah, so for example, one of our backroom members had a huge exit, tens of millions of dollars they received, and they decided they wanted their next business to go into to be commercial real estate. Right? I trust this person, I trust the strategy, and this is going to be their now full-time focus.
Yep.
And I've invested in their business,
Absolutely.
which now buys up real estate, which is fantastic. Mm-hmm. I know that he is all over that. I'm not going to go try and buy up commercial property. That's not my business.
I understand completely. I actually think I know who you're talking about, and he's bought some properties in Oklahoma.
Mm-hmm.
Yep, there we go. So and absolutely, you now go have a quality person who had at least enough wherewithal to know how to go build a multi-million-dollar business. So, I mean, that's not that money is the only better you need. It does help a little bit to say that you were at least successful in this area. And then you take that over, and now so you have someone who's a quality person, who's got character, who's competent, is intelligent, who's going to dig into this, and they're going to put their full-time energy, effort, and skill sets into going and building your wealth. That's outstanding.
So this feels like a really good place for us to wrap this up with a pitch for our stuff. So here's so obviously we covered a lot. We covered what the heck capital warehousing is. We covered what we absolutely know is going to happen in the economy this year, because it's going to be so predictable and we're going to get every prediction right. We talked about little ways of producing cash flow that a lot of people don't know about. What the heck do you do with this now? I have spent my life answering that question. I've spent my life trying to figure out the question of, I know a few things, now what? And trying to find the next thing. And this is what we compile inside of the 1%. So we break down the capital warehousing strategy with Sam. We look at other plays to put that I'm specifically, myself, personally interested in for cash flow plays. We talk about when to buy stocks and when to utilize things like naked puts. This is where we apply this stuff. And that's you can get that over at capitalism.com. And it's called the 1%. That's our monthly program where we're going into each one of these individual strategies and actually applying them so that you can use the ones that are right for where you are in the stage of your journey as an entrepreneur. Sam, where do people find you?
If you want to look me up, go to wealthwarehouse.com. So wealthwarehouse.com, or email me, Sam@wealthwarehouse, and I don't know. I don't have a whole lot of social media. That's one of my goals for 2019. Right? Is I'm going to actually get a little bit more of a social media presence. I'm going to get one of those Instagrams and some Twitters and I don't know, whatever it is. But
in the meantime, you can just keep dropping gold on the Capitalism podcast.
That's the plan.
All right, Sam.
Appreciate it, buddy.
Thanks for your predictions.
I like it.
Thanks for hanging out with us.